12 years ago, I made the best financial decision of my life that holds true even today. As a young 10-year-old, you'd probably catch me playing the latest video game for devices like Nintendo Wii, DS, or Xbox. I was not focused at all on finances. I was focused more on buying the latest and greatest game that was about to be released, like Mario, Super Smash Bros., Pokemon, you name it. That was my focus. But that all changed in 2007 with the release of two revolutionary products that have defined how our society interacts ever since. Those products, of course, were the iPhone and iPod Touch. These devices immediately stood out as the first of their kind with multi-touch displays and the ability to play music and look through past photos taken on the quality cameras, at least at the time, all in one device. And I was fortunate enough to get one of these iPod Touches that year for Christmas. And immediately, I knew these devices were one of a kind. But how does this relate to the best financial decision of my life? Well, these products opened my eyes to the company Apple. I had never used one of their products before, having only used PCs at home and at school. But the iPhone and iPod Touch immediately gave you a feeling of satisfaction, whether it was from the feel in the hand, the large screen, the user experience, or just the overall build quality of the device. To put it mildly, I was a fan. And somewhere along the way, I began to realize that these devices were the next big thing that everyone would have to have. No other product existed on the market that had the feature set of these devices or even the build quality, putting Apple's products miles ahead of the practically non-existent competition. And it was this recognition, as well as my own personal love for the products, that led me to invest in Apple stock. Of course, with some help from my parents because I was a minor. Today, that investment has rocketed higher, with my initial shares increasing to more than 11 times their initial value. Let me say that again, 11 times. But how did this happen? What was it that my small 10-year-old self had started to stumble across without realizing that ended up making this investment so successful? It all comes down to two words: competitive advantage, or what Warren Buffett often calls a moat. Finding and investing in companies with a competitive advantage is the most important factor for successful investing. Though you might end up investing at the wrong time in the short term, investing in companies with a competitive advantage, specifically a durable competitive advantage, will prove profitable in the long term. And if you don't believe me, look at the chart of Apple stock between 2007 and 2009 during the financial crisis, but after the release of the iPhone. Find the stock's peak during that time frame and compare that to the stock's value today. Let's just say you would have still done just fine, having made more than 11 times your money today as well. In fact, I may have bought shares around the peak in the stock during that time. And I'm not complaining about the stock's performance, not one bit. Investing at more opportune times is secondary to buying shares in the right businesses. If you want to learn more about how to invest at more favorable times, subscribe to the channel, as I will be covering that topic in more detail in future videos. When I was 10, I had picked up on one facet of competitive advantage, and that is a superior product. A superior product or service can allow a company to flourish, especially when others are unable to copy it. In the case of Apple, they had revolutionized the phone, adding features that no other phone had and in a package that no one was able to emulate for a few years. This gave Apple the advantage that over time has grown larger as they have introduced new products and services that tie their entire ecosystem together in a seamless manner that no other hardware or software company can match. This is at the core of Apple's competitive advantage. They make both the hardware and the software for their products, which ensures that they work smoothly, and the resulting quality and reliability is the reason people choose their products. There are other forms of competitive advantage as well, and generally I'd suggest that you start your search with the best brands. In fact, think of the businesses that you, your friends, your family, and others you know like and buy products or services from. You may find businesses that have a competitive advantage there. And though my initial gut feeling with Apple worked, and that strategy can sometimes lead to strong investments, it does not always pan out. So how can we determine which companies have this durable competitive advantage? Well, you have to dig deeper by thinking about the underlying business and looking at their financials. Doing this research is the only way to feel confident about investing in a company. Find these companies that have staying power. That is most important. Then consider price. You may find companies with a strong brand that are fully priced or even overvalued, and you may decide that you want to invest in them at those high prices anyway, and that is fine. Warren Buffett is often quoted stating that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That is why I want you to find these good quality companies first. Once you find these companies, you can worry about what price you'd like to buy them at. Price is always secondary, though ideally you would like to buy them at a discount, which would allow for you a margin of safety in case your prediction is wrong in the short term, or outside forces that tank the markets don't hurt your investment or potentially scare you out of a good company. Personally, I try to identify these companies, determine if they truly have a durable competitive advantage, and then determine what price I think is fair, or even what is a good price to pay for the company. Once they hit my target prices, I buy shares in those businesses and buy more and more aggressively as their share price moves lower. But how do we dig deeper and truly figure out which companies have a competitive advantage? And how do we determine if a business is priced in the stock market at a good, fair, or overvalued price? These are questions that we will explore further over the next few videos. I will be detailing how to identify these companies through lessons I have learned reading about Warren Buffett's own investment methods. I have learned to implement these methods over the past few years and have fine-tuned this strategy over time for my own investments with the hopes that it will generate stronger returns. And so far it has worked. So I'd like to share this strategy in detail so that you can decide if it will work well for you. Keep in mind, you have to do a lot of groundwork for individual investments. If you don't want to put in the time, you can just invest in index funds. That is the best way to do it if you don't have the time or inclination to do this. But if you are interested in learning these investment methods for individual stocks, the investment methods that Warren Buffett uses, subscribe to the channel and like this video so that you can see future videos about this content. Thanks for watching, and I will see you in the next one.